Imagine it's 1:59 p.m. in New York. You're staring at your EUR/USD chart, and the price is barely vibrating in a tight range. You are nervously waiting for the official news release. Suddenly, the screen explodes. A massive green candle shoots up 80 pips in seconds, only to be swallowed by a 120 pip red candle a minute later. Your stop loss is hit. Your trade is wiped out. The news officially announced a U.S. interest rate hike. Normally, higher rates strengthen a currency. So why did the U.S. dollar just collapse? To understand that, you have to look at the institutions pulling the levers: the Federal Reserve and the ECB. These are the ultimate market makers, the institutions that set the rules of the entire game. Intermediate traders get wiped out in these moments because they are reacting to the headline. The institutional market, however, is already trading the future. Most major central banks operate under a strict dual mandate. Their entire policy is a balancing act. They want to keep inflation hovering around 2. They use highly specific vocabulary to signal their next move. Hawkish means they are aggressive on inflation and want higher rates, which is bullish. Dovish means they are worried about employment and might lower rates, making it bearish for the currency. They drop these hints in speeches and press conferences months in advance. This tactic is known as forward guidance, and it allows them to steer the market without actually touching the interest rate dial. This dot plot shows where central bankers expect interest rates to be. If analysts project a 0.25% hike, the market buys the currency for weeks. When announced, buyers take profits, and the currency violently sells off. The expected rate doesn't cause that explosive post-release volatility. The violent whipsaw happens when the actual central bank statement deviates from what the market forecasted. To survive modern Forex trading, decoding the sell linguistic shifts in the press release is vastly more critical than reacting to the headline interest rate number. Instead of gambling on that unpredictable initial news spike, professional traders use a specific technical setup called the post-release correction play. Look at this diagram of an initial news spike. Notice how the bid-ask spread rapidly expands in the UI interface. During that first 5-minute candle, extreme spread widening and slippage will trigger your stop loss, regardless of which direction you trade. You have to wait. High volatility moves almost always see a partial retracement as algorithms take their profit. You watch the chart and wait for the massive price spike to pull back toward a standard Fibonacci retracement level, like the 50% mark. Once you spot a bearish technical signal at that retracement level, like a pin bar, you enter a short position. You then protect your capital by placing a strict stop loss 10 to 15 pips above the absolute peak of the initial spike. Technical analysis shows you exactly where to enter the market, but central bank policy reveals why the market is moving and how far it will go. Ready to put this into practice? Join thousands of traders on NX1 and trade the news with next-generation technology and ultra-tight spreads.